Matt, good to see you. We have a great topic today. Is cash value life insurance a ripoff? Everybody's paying attention now, right? I feel like everybody has a love-hate relationship with cash value life insurance. And I think a lot of that is because people have a lot of misconceptions about it. So we're going to break down some of those misconceptions. Let's start with the fees, because a lot of people think that those fees are prohibitively high when it comes to cash value life insurance.
Aaron, this is a great topic and one I have a lot of experience on. I've been in the business for a long time at insurance companies as well, and they're all over the sun. You come in the door, they're teaching you sell life insurance. Ours is the best. Here's why. There's books going back 40 years, like the Bank on Yourself concept, saying you need life insurance. You need life insurance. And does it work? Sometimes. A lot of times it doesn't, and a lot of times there's a lot of fees that the person buying the product are not aware of. And I'll be honest with you, Aaron, a lot of agents aren't aware of it either. They don't know how it works. But what they do know is how they get paid, right? And what we have, every life insurance policy has two buckets. You have the cost of insurance bucket, right? This is the death benefit. This is administration fees. And then you have, when I say life insurance, every cash value life policy, permanent life insurance, whether it's whole, IUL, or variable. Whole and variable tend to have larger fees. So let's not talk about that. The IUL can have lower fees if done correctly. If done incorrectly, it's just as high as the others, right? So you pay $1, and out of that dollar, 15 cents off the top could be a premium fee, right? In other words, and that's only on the new dollar coming in. So I put $1 in, and then 85 cents left over can come over to, the accumulation bucket, right? So premium fees only on the new dollar coming in. Later in life, that there's no premium fee, the following year on that dollar. So the fees can be high. Agent gets paid on the cost of the insurance. So they're incentivized. If you put in $500, they want $490 of that to be life insurance. And then you got a whopping $10 going into your accumulation product. It's not going to do most likely what you were sold on it for. Just to be clear, there's so many different uses for this product. What we're really talking about is when someone comes in and says, hey, this is an alternative to your retirement. If they're saying it's alternative to your retirement, then we want to make sure it's done correctly, which is reversing the two buckets. Reversing the two buckets means, if I pay $400 or $500, I want, $30 of that to be the insurance fee, cost of insurance, and I want the rest of that, the $470, to be the accumulation bucket. Yes, fees can be high, and people don't get it, and they forget 3 years later, and they feel like they're getting ripped off.
And they are high, right? For the first 10 years or so, depending on how it's structured. So this is something where you kind of want to be in it for the long haul, right?
Definitely. Yeah. What I tell people, and this is whole or UL, it's a 10-year deal. I mean, if you can't heavily fund it for 10 years, don't do it.
Now, explain the difference between IUL, indexed universal life, and whole life, cash value life insurance.
Good question. So whole life is the oldest type of life insurance, been around hundreds of years. And the idea with whole life is initially you have a higher cost of insurance, but over time, because of inflation and value of the dollar, it's going to feel like it gets lower later in life, right? But whole life, generally, you're going to have a higher premium when you start out. And it's going to have, in my opinion, a higher cost of insurance. But the idea is eventually after, 30, 40 years, it's what we call paid up. And paid up just means, you have enough cash in that policy to where, you pay it 105 grand and you have $100,000 in there, right? So that's kind of how whole life would work. On an IUL, it's going to be a little bit different in the sense that, and this is what the whole life guys are going to say this about an IUL. They're going to say, well, Matt, the problem with the IUL is the cost of insurance can increase in time as you age, like a term. If I'm 53, well, then it goes up a little bit. That is correct. The cost of the insurance does increase, but done correctly, I'm buying less insurance. So on day one, if I'm buying a $100,000 death benefit, I'm paying for $100,000 of life insurance, right? But on year two, I put in 20 grand, right? Well, now I'm paying for 80 grand of life insurance. So the unit may be a little bit more expensive because I'm 1 year older, but eventually I have so few units of life insurance and the accumulation bucket is so large after 10 years that the interest that I make in my accumulation bucket exceeds my cost of insurance bucket. So it can get very confusing. And again, there's so many parameters here. but that's why we're here to help bring some clarity.
So, who is this for? When does it work? When does it not work?
Well, if you work at a life insurance company, it's for everybody, right? If you work at one of these people, I'll just insurance companies, let's say, where it has insurance on the name, chances are you need it, Aaron. You need it. Your kid needs it. Your grandma needs it, who's 95. Everyone needs it, Aaron. Now, I'm being facetious, of course.
Yes.
In my opinion, so if you were to come into our office, we have a spreadsheet where we put your total life, financial life in one spreadsheet. It shows your qualified money, your 401ks, your 403bs. It shows your bank money, money we can get today. And then it shows your Roth IRAs, and then it shows your real estate, and then it shows, your cash flow. So generally, in my opinion, all not counting for estate needs like, term life and whatever else, because there's definitely a need for that, not counting for death benefit needs. But generally, to consider it as a financial product, we want to make sure all those other buckets are in line. And for the average consumer, it can take quite a while to get those buckets in line. By the time you get in line for the average consumer, it may realistically never be something that would work for them. You're 70 years old and you finally get all those buckets. Well, the cost of insurance is so high, it's not feasible to have it.
Now, when structured correctly, though, cash value life insurance offers tax-free growth, tax-free withdrawals, and then, of course, the tax-free benefit to your heirs when you pass.
Yes. So I talked about the negatives. Now I'm going to talk about the positives.
Yeah.
Exactly what you just said. I'll tell you that the benefit of it is this. I mean, there's no limitation. Well, in theory, I mean, there are some limitations, but they're very large limitations about how much you put in, right? But there's you can put a lot more money in, and there's no restrictions on when you take it out. You can put 100 grand in today if your death benefit's high enough, and then you can take 100 grand out tomorrow as a loan, right? And not to get too much into the weeds, but I could take money out and still receive some interest on that money I took out, called a participating loan, right? But the beauty of it is done correctly. It's also tax-free income to me when I take out the money. And it's also tax-free to my beneficiaries.
This is great. I feel like we could have had this chat for an hour because there are so many misconceptions. And as you mentioned, though, Matt, it really is different for everybody and it has to be structured correctly. So if somebody wants to have you run those numbers on your spreadsheet and see if this is right for them, what's the best way to reach you?
The best way is by phone, 425-256-3105 or mberkland@choosevault.com.
All right. Again, Matt, thanks so much for your time today. I really appreciate it.
Thanks, Aaron.